You're getting ready, Richard, to write the weekend note. Give me the theme. I'm going to give you an open question to get started. What's the theme going into Monday?
So first of all, Tom, great to be here. Thank you for having me back. So we look at the drivers of markets. What are the themes driving this V-shaped rebound you showed earlier? Well, two important drivers in our view. So the first is this huge U-turn in terms of not just Fed policy, but perceptions about central banks around the world. So markets now increasingly confident that the Fed's on hold at least through the middle of this year, but also that other central banks have become more dovish as well. We've seen that from the ECB, the Bank of England, Bank of Japan, and importantly, People's Bank of China. So monetary policy, confidence around central banks being on hold and remaining in easy territory, I think the key theme driving markets. But there's been a second important theme as well, which has been some of the heightened concerns about geopolitical risk, particularly US-China trade tensions, which contributed to that sharp sell-off we saw in the fourth quarter of last year. Market perceptions have turned around very quickly, and there's increasing confidence that a deal can be done.
Richard, you know I'm in the BlackRock triple leverage all cash fund, and of course on December 23rd you advised me on the show to go into the triple leverage all cash fund. Let's just look at what I missed. Bring it up on the screen, folks. Turnill knows this. Double digit, Dow up 11%, S&P up 11%, NASDAQ all in composite up 13% in 6 weeks. Is it too late to get on board? What do I do to reallocate right now after I've missed this historic move?
So last year we saw an extraordinary sequence of events. We actually saw an environment where cash was the only major asset class to provide positive returns. So you saw negative returns for global equities, negative returns for global bonds, negative returns for global credit. So really the only place you could hide was in cash. And as short rates rose in the US, we saw many investors choosing to seek protection in cash at a time when interest rates were rising and offering positive returns for the first time in several years. But this year, what you're seeing is a reversal of that trend. You're seeing investors starting to step out of cash again. You're seeing material flows back into assets like fixed income along the curve, into longer duration bonds as confidence around the Fed being on hold has increased, but also into areas of equities like emerging market equities. So our view is, if you look at this in a portfolio context, it's not too late to be invested. Cash here offers a relatively low return going forward. You see fixed income now offering attractive returns and diversification in portfolios. So stepping out into fixed income, particularly in areas like US fixed income to us, I think makes a lot of sense. In equities, our message is don't chase the rally, don't buy everything, but there are areas within equities which are still unloved, areas where valuations are attractive.
Right, such as?
Emerging markets we'd still point to. They've done well in the last few weeks, but coming off significant declines last year.
But are you expecting US markets to actually flatline this year?
We see positive returns from US markets, but don't extrapolate the very, very strong double-digit gains we've seen in the first 6 weeks of the year. We see those positive returns being driven much more by earnings growth, by dividends. We've had a huge re-rating, so our message would be don't expect that re-rating, increase in valuations to continue. But we're still at a point where equities, we think, offer in aggregate attractive returns, but there are risks.
But Richard, if we have the US-China trade actually being dealt with, does that mean more positive earnings and forecasts?
Well, we're seeing downgrades right now to GDP and earnings growth expectations, and we look forward to the rest of this year. We see potential for further downgrades. But what we believe is that the risk of recession this year is still very low. And that we're in a period of late cycle slowdown. Those periods of late cycle slowdown have historically been associated actually with maybe surprisingly positive returns. So think about the late 90s or 2006-07. Late cycle periods, slower growth, but actually surprisingly positive returns, but also higher volatility. So what that means is, yes, you want to have risk in your portfolio, but you want to balance that risk with areas like fixed income, which can offer diversification if we see some of the volatility return that we saw last year.